Okay, we'll go ahead and get started. I'm Owen Bondurant. I'm a partner in Independent RX. This is our uh, monthly webinar we do. Today we're going to be talking about using reading and understanding financials and other data, and kind of going through how we look at this when we're doing a review. This webinar is being recorded. So if you have to drop out or can't stay for the whole thing, you can find it later. We'll send it out via email, YouTube, LinkedIn. So it is being recorded. There is a Q&A at the bottom of your screen there. So if you have questions, please drop them in there. We'll do our best to answer as many of those as possible. We may answer some as we go. If not, we'll wait to the end and try to cover as many questions as we can. Again, I'm Owen Bondurant. I'm a partner in the company. I handle a lot of the starting, buying, selling of pharmacies. Been in pharmacy pretty much all my life, doing every role except for being a pharmacist. This is my business partner, Rich. I'll let him introduce himself.
Yeah, thanks, Owen. Like I said, I'm partner with Owen and Tim and Heidi, and we are IRX. IRX was formed out of actually owning pharmacies. So we owned pharmacies. I was a minority owner with Tim and Owen's father back in the day, and owned, I think, up to about 17 stores at a time, and learned a heck of a lot about pharmacy. My background is actually I'm a CPA, so I was the finance guy and the CFO of the business, and came from public accounting, one of the big public accounting firms, and then also a big Fortune 100 technology firm. So nothing to do with pharmacy until about 20 years ago, and started down this path. And about 7, 8 years ago, we started this business, and like I said, Owen was doing lots of start buys, and so we were getting pharmacies going all across the country, and a lot of those pharmacies asked us to stay on and consult with them. And that's kind of my role, is to run the ongoing side of the business. And ongoing means initially it meant just consulting with them and helping them operate their pharmacy, right? And very quickly realized if we didn't have data, we didn't have much of a business, right? And it was going to be a lot of work and digging and trying to figure out and recreating. And so that's what led us down a path that eventually led us to doing all the accounting, bookkeeping and accounting work for pharmacies, and ultimately tax work as well. So we do accounting, bookkeeping, accounting, tax work. And what makes us a little different, we're not an accounting firm, and we didn't go from being an accountant to trying to understand pharmacy. We went from pharmacy ownership to doing accounting and financial work for pharmacies to help them better operate and understand their business, right? But you can't understand your business without data. And that was when early on, when we were sitting down trying to figure this out, that was the key discussion. Without data, you're just a guy that's trying to recreate and ask questions, and so we quickly realized that we had to have data, and not just financial data. So pharmacies, one piece of the equation is the financial data, and that needs to be as accurate as possible. But they also have a lot of operational data coming off your pharmacy system: what scripts are you filling, and what's your brand and generic mix, and your volumes, and who your payers are, and all that stuff. And so there's a lot of data there. And then also the payroll system is kicking out some pretty important data every 2 weeks typically. So that became the core of the business, is that we can only scale this and work with a number of clients effectively if we have all that data at our fingertips. And it's the same stuff when we had 17 stores and we were in 3 states. We had to collect all that data, and we've gotten a lot better at that. Yeah, so we've got it all on dashboards now and stuff, so it's at our fingertips in ways that it wasn't historically. But that became kind of the impetus of and the foundation of our business. And so I think today, when we were kind of brainstorming ideas of what we wanted to talk about in this monthly podcast, that the challenge is, what do we do every day, right now, especially when there are a number of stores that are obviously cash flow crunched. and they're struggling to figure things out and they're working through it. Some stores are doing just fine. So a lot aren't though. And so we're getting those questions all the time. So Owen and I spend a very significant amount of our time working through those. And so we wanted to walk you through what our process is when we need to have a conversation or when we're having those regular conversations with our stores. What do we go through and look at so that hopefully you can take some pieces of that and incorporate it in your own store and make sure that you're looking at your business in a way that you understand kind of what's going on, right? Because if you're not, it can catch up to you quickly.
Yep.
So, that was our thought for what we're going to try to get through today. And, it starts with the data, like we talked about. But then you got to organize that data, and you got to have tools to organize that data. And then ultimately you have to have a method to interpret, what your tools are telling you, or what your organization of that information, now moving from data to information, what that information is now telling you.
Yeah, and we see, those tools do a couple things for us, and we have challenges that occur with our data. Is that, as Rich mentioned earlier, the data is coming from all these different areas. So the data that you get is disjointed, right? We have pharmacy system that has lines and lines and lines, and we can run, I mean, how many reports do you can get out of a system now? It's top 100 and top revenue and RX summary, and the RX summary has hundreds of lines and all of this. Then we have payroll data that shows us actually non-financial stuff like hours and overtime and, things in like just pay and who's getting benefits and things like that. And then we have financial statements, which seem simple, but, everyone's financial statements are different. We get P&Ls that are, just year to date, not month to month. They have no, historical view of them. You get your income statement, you get your balance sheet, you get your cash flow statement. They all tell you different things. So suddenly we've got all these pieces. So yeah, we got to have these data points, and they're all have value, right?
Mm-hmm.
But then we have the accuracy of that data as well. And a lot of times these data points are not accurate.
Yeah.
And so then we come down to these tools. So all those things make this challenging.
Right.
And so having tools to let you know how to interpret that and make decisions out of it is important. It also tells you what's accurate and not accurate, and gives you some ideas of whether or not your data is correct.
Well, and it goes back to that first point about the data. It's okay, you got to have data, but if the data is not accurate, then it's kind of challenging to use, or at least you have to understand what parts of it aren't accurate, right?
Yeah.
Because
Yep.
What you can use, what you can rely on, what you probably shouldn't be relying on, and where you need to do some work, right? So with all our pharmacies, the biggest challenge is getting inventories and cost of goods sold correctly, costed within the system. And it was a problem when we had our stores, and it's probably always going to be a problem. So, and we won't dwell on this too much, but trying to make sure that data layer is correct, because you can organize data all you want, but if it's not good data, then it's not worth what it's written on. So the first part is trying to get the data, get access to the data, and get it as correct and understand the data that you've got. And then when we talk about organization, a lot of it comes down to just the reporting. And so that's why we've got a dashboard that we use with our clients. It's 4 pages of information. It's both operational and financial and payroll data. There are metrics on there. So stuff that we're used to looking at and seeing, and the way that we want to see it and think that our clients can use to see it. But for instance, in our financial package, and we can talk the difference between accrual accounting and cash basis of accounting. And we do cash basis of accounting, and I'll go through that real quick. Part of that is because financial or data on your pharmacy system is often not correct. And if you are using information from your pharmacy system to drive your financials, then neither one of them are correct. So when you do cash basis of accounting, and nobody's 100% cash basis, but there's some modified cash basis form. When you do cash basis, your information source is the bank. What's going in and out of the bank, or what's hitting your credit cards, or so your financial institutions are your source of data, not your pharmacy system. And so I can tell you 100% that if you are reconciling your bank statement, then those financials are correct. Now you have to understand how to read them, and they may be a little different than looking at accrual-based financial statements, but they're 100% correct. And if your pharmacy system is accurate, you've got the accrual over there, because you can run a monthly summary report and it'll tell you, I filled 5,000 scripts. Here's the cost of those 5,000 scripts theoretically. And
Yep.
here's theoretically what I'm going to get paid for those 5,000 scripts. There's the matching that occurs in your pharmacy system. So you've got the accrual view of your pharmacy over there. Over here on the cash side, it's telling you what cash is coming and going. And so with that said, either way, from an organizational standpoint, when we look at our financial package, the first report that we run is a year to date. And so at this point, we're through April. So it's got 4 months and it's got a total year. And that's the P&L. And so that's a great view of a snapshot today, where things are. The second report is a 13-month rolling P&L. So instead of just having 4 months, it's always got the most recent 13 months. And the reason we choose 13 is if we're looking at April, our latest month, now I can look at April of last year, right? So I can compare month over month where I was last year and where I am this year in April. And there are some interesting things that are happening there right now. We've got the doubling up of the DIR fees with the Caremark pullback in March and April and a little bit May now. So you'll see that impact. Revenues are probably going to be down because the revenues are down at the register because the DIR fees are now basically incorporated into the original sale price. So there's a number of things at play there. But we like to see that 13-month rolling, and now I can look across 13 full months of data. I've got a year-to-date number there, so I can see through April of this year, and then I've got the year-to-date of last year through April, so I can compare year over year, through April of 24 to April of 23. And then probably the most important piece that we use all the time is the 4-month average. So that last column always keeps a rolling 4-month average of every line on your P&L, right? And we'll get to how we're going to use that in a second. So and then the next statement that we issue is a 5-quarter rolling view. And what that does is no matter whether you're accrual or cash, your margins and your expenses tend to rise and fall significantly month to month to month. So you're looking across there and you're trying to figure out what the trend is, right? And with those big ups and downs and swings, it's sometimes hard to get your head around, what is the real margin, or what is the real revenue, or what are my actual rebates or payroll, any of the lines there. So we take 5 3-month segments. So the most recent would be February, March, April, and we group those. And then, so now with 5 of those, we've got February, March, April of last year, and we've got February, March, April of this year, and we can make a comparison, and that tends to smooth out all those ups and downs. And then we even take it a step further and we show that as a per month view. And that's going to kind of get into our method of interpreting the data is to try to get that smoothing effect to the data to say, over time, what are my margins? What are my payroll costs? What are my other operating costs and so forth?
Yeah, I mean, it was odd because, Rich and I will do these reviews and we kept talking about, I do a review and come and ask Rich a question. We found that we were both doing these averages in the exact same way because we want to compare, okay, well, how, it's April or it's May now, how did the person do in February, March, and April? And how does that compare to last year? Like, I mean, a great example is he mentioned the DIR fees. Well, like, is is it really down by your DIR fees from last year? Does that actually kind of match? Is that making sense? Like, if I go last year and I look at the 3 quarters, what were your DIR fees? Oh, they were that much. Oh, wow, your sales are down. I can put the 2 and 2 together. And so having again, it's another tool to kind of compare things and give you a quick glance of has things drastically changed. Um, and that's what we're trying to do is see if is there something we need to look into further that's not making sense when we look at that.
But I think for all of us and for me, even being in the finance side of the business for 20 years and before that, being in large public companies and looking at data all the time, financial data especially, simple is best, right? And so trying to keep it simple, but at the same time, and I think that's what looking at your monthly numbers and boiling it down to, okay, where am I currently at on a monthly basis? I think that's something you can wrap your head around pretty easily.
Yeah.
And so, if you're looking at, looking at your revenue and your cost of goods and coming to a gross margin number, that is the hardest thing in pharmacy, right? If that were all straightforward and simple and clean, we might not even have a business, right?
Yep.
Because that is one of the hardest things in pharmacy is to get your head around what your margin is. But that's the thing you need to really focus on because that's going to drive everything. So if we've got if we've got $400,000 of revenue every month and we have 300 and whatever 300 or 420 of cost, let's say, so we've got $80,000 of margin. That $80,000 of margin, that is the key, right? That's what's going to pay all the bills and not just the bills, but the debt, and hopefully give you a distribution on your company and give you a return on your investment and your hard work. So zeroing in on what that margin is per month is really, really important.
Yeah, but like looking at it on a quarterly or a rolling 4 month, it gives you better averages because, in the fall, you do a bunch of flu shots, your sales are, artificially increased for that period for a couple months. But you can't use that month to like kind of forecast forward or do the norms.
Right.
So if you've got these continuously rolling 4 months and you're always looking at them, you start pinpointing, well, normally I'm at about 80.
Yep.
Right. And so that way, if it comes in at 70, you're like, okay, what's going on? Or if it comes in at 90, do you go, oh, that's flu shots. I can't account that. That's not going to continue. It's going to go back down to 80. And so that rolling 4 month, like if you're just looking at it all the time, then you can kind of every month you'll be like, oh, it's averaging out to this again. Oh, it's averaging out to this again. And if your business isn't growing and it's just flat, like it'll almost every time come in about the same. It may differ by 1,000 or two, but that general number will be there.
But if you're looking at it monthly, that's probably not going to be the case.
Yes.
It's going to swing wildly, right? Like you could have a 10 or 12% margin and all of a sudden you drive, 60 or 65% or 60 or $65,000 of margin and you go into panic. And it might be just timing on a Caremark check. It's going to come in on the 1st and we're doing cash basis. So it wasn't in the financials on the 31st. So one day can swing the financials wildly. And that's the problem when you're looking at month to month to month to month. And then the next month, there may be an extra Caremark check in there. And all of a sudden you did a 26% margin, right? Yeah. And so those are the swings we're talking about. And when you can zero in and say, okay, over an extended period of time, and when I take out the anomalies, like, the vaccines in the flu season, or obviously COVID changed a lot of things that we knew weren't
Right.
permanent changes. But when you can zero in and say, okay, my margin is it $40,000? Is it 80,000? Is it $100,000? And so now you've basically got a guardrail that the rest of your business has to live within, right? Because so if we're at 80,000 of margin, next biggest line item and biggest expense after the cost of drugs is your people. So what's your payroll? And not just pure payroll, but also payroll taxes, benefits, anything that you're spending on your employees, we consider personnel costs. And so that's that next line item for us and it's a number, it's usually broken out: pharmacist, technician, driver, clerk, payroll taxes, bonuses, employee welfare, benefits. So we have some detail there, but at the end of the day, you want to know, what are my personnel costs? And so sometimes when we see people's P&Ls, we'll see, oh, here's their wages and here's their payroll taxes and here's their benefits. Maybe it's alphabetically ordered.
Yeah.
But I need to know what their personnel cost is, because if you have $40,000, let's say you've got $40,000 of personnel costs, you've got $80,000 of margin, so you've just spent 40 of it, right? So you've got 40 remaining. And so zeroing in on first the margin, then the personnel costs, then we lump all other costs together, basically from your rent and marketing and pharmacy system fees and credit card fees, insurance. I mean, we do have them broken down between pharmacy other cost and general and administrative other cost, but all other cost. Typically, those in a store run somewhere between 10 and 20 grand a month.
Yep.
So now we've taken our 80, we've got 40 for personnel costs, we've got 20 for other operating costs. Now we've got $60,000 of expenses, right? So 80 minus 60 leaves us 20 grand of what we would call operating income. And that's the income that the store is producing, right? And hopefully that number at that point is positive. If you're not doing enough volume and you've got big payroll costs, that number could be negative at that point. But there's still more to come, right? Most people have debt associated with their store. And on a P&L, you typically have interest expense. You don't have the principal payments. Those hit the balance sheet. Those are a reduction of borrowing. So those hit the balance sheet only. But we look at both the interest and the principal payment. So, if that could be $5,000, it could be 15.
15, yeah.
If you're a big store, it could be $60,000 a month. So once you back that out of operating income, what's left over? So that's kind of the progress or progression, and it's all on a monthly basis. Gross margin, then from that, personnel costs, other operating expenses to get to operating income. Know what your operating income is. Hopefully it's positive at that point. And then back out your debt service, basically principal and interest. So in our example, let's say that's $15,000. So now we've got $5,000. And the only other piece that we kind of always consider there is, what are your distributions? And distributions are a balance sheet only item. So they're coming out of your equity and they don't hit your P&L. But if you are established as an LLC and you are an owner and you are paying yourself, technically you have to pay yourself through distributions, or you can do what's called a guaranteed payment. And a guaranteed payment can be on the P&L, but distributions typically are off the P&L. So we want to also figure out, what are you paying yourself, right? So some of it may be up in salary, some of it may be down in distributions. So that's the last piece of the equation. So if, again, you've got $5,000 after debt service, if you're taking a monthly $5,000 distribution, then you're basically a break-even enterprise from a cash flow standpoint, an operational cash flow standpoint.
Yeah.
And so that's what we're trying to get to. And I think every time we sit down with a client, we go through that exercise, and our dashboards are meant to give us that information pretty quickly.
We actually summarize it for them. In the dashboard on the main page, we take all that and summarize that for them. but part of the reason we're doing that is even when we're helping someone acquire a pharmacy, I mean, the first thing we do is what's the average margin? Like we try to average it over the years. What's the normal payroll from year to year? What's the total operating, what's the other operating expenses? So we're not going at first like they spent this on utilities and they spent this. We just want to know what are the general numbers and what's left at the end.
Mhm.
And I think you need to go through that exercise and should know, on a regular basis, here's my numbers. Like if someone would ask you, how much cash do you, like, what's your operating income? You should be able to go, well, normally I do, 400,000 in revenue. I have 80,000 in margin. My payroll costs tend to be 40. My other tend to be 20, and then I have debt at 15, so I'm left with 5. Like that should just roll off of your tongue. And that's exercise number one when we start looking at like doing a review of an account or an acquisition. Like, what does that look like? Because that's ultimately telling us, how much cash do you have?
Yeah, what are we dealing with here? Because is that number positive 20 or is it negative 20, right? And drastically different scenarios there.
Yep.
And if it's negative 20, we got a lot of work to do and we got to figure out things quickly because you're depleting your working capital. And I do think going back to that whole monthly view, I think it's just easy to wrap your head around and say, okay, I should be driving about 80 grand a month. Now you can't go into panic every month because it's never typically you're not going to see 79, 80, 81, 79, 80. You're going to see big swings around that, but you got to continue to look at that 4-month rolling average and see, am I maintaining that roughly 80 grand of gross margin a month? Because I've got these other expenses, and same with your payroll. So what do you do with somebody that, you get to the end of the day or at the end of the calculation and they're at negative 10?
Well, if they're at negative 10, then what I do is I go back up top and go, do they have even enough revenue? Are you selling enough? Right? Or are you, so that's top line. Like, are you doing enough prescriptions to even be positive? Right? So now we're starting, and then we go to the cost of goods. Are you buying too much? Are you just not buying correctly? What's happening here? Or do you have too much payroll? So I'm trying to identify which of the areas is off, right? So if your margin is 12%, should it be 12%? Or should it be 18, right? And then if payroll is high, right? So if I look at the payroll and I go, oh, it looks like you should be staffing, 100 hours of techs and you're staffing 150. Well, then now I know your payroll's too high, right? So I'm trying to identify where's the hole. And that's where, we're moving from the financial document over to other pieces of data to tell us what's happening in that calculation. And I guess the vice versa happens too. If I see that someone's making 20,000 a month, then I go, well, why?
Yeah.
Why are they buying really well? Do they just have a really good mix of business, like a ton of generics, that have good margin on them, or they have compounding or something? I want to understand what's driving that profit, because then going forward, we want to make sure whatever's driving it doesn't change.
Right.
Because it'll tell us before they have a problem. So I think that the next thing I always do is go find out where's the hole, and I'm using other data. So going back to the beginning of the RX data, the pharmacy system data, the payroll data, we're going in there and we're trying to determine what's wrong. And that, and that starts telling us where they should spend their time.
Yep. And I mean, your point is, and we've kind of preached this, it's really in a simple form, it's one of three things.
Yeah.
It's the volume. Either you don't have enough of it, or you've got a bad payer mix or a bad product mix.
Yep.
So it's volume related. It's purchasing related. Either are you buying 100% on your McKesson contract? You probably shouldn't be, right? You
Yep.
got to go buy your generics. You got to find the right contract that works for you. And not all buying group contracts work for every store. Every store is unique. So you got to be a smart buyer.
And are you buying within that contract properly? We see people not max out. They could buy $100 more and get a significantly larger rebate.
The simplest one to fix on the buy side is you're buying too much.
Buying too much. That's probably the most common one
You're building inventory.
Yeah, building inventory.
You're exchanging a cash asset and you're putting it on your shelf and you'd rather have it in the bank instead than on your shelf. So volume, purchasing, and payroll.
Yeah.
And today in today's, economic conditions for pharmacy right now, you got to do all three really well, right?
Yeah.
You really can't have holes in any one of them. So, and again, the data and the organization of the data and the understanding of the data allows you to pretty quickly say, okay, I'm over payroll. So now the hard part comes is you got to go fix that, right? Or, one of the other things we were talking about that we do when a new client comes on board, the first thing that I'm most anxious to see is not the P&L. It is the brand generic mix and the volume.
Say that, yeah.
So, we have that information. We look at it on every client and what we're looking for. So what I'm looking for is I want at least 90% of your fills to be generic. I want at least 20% of your revenue to be generic. And I want it to be hopefully, and this one's getting harder and harder, $20 a script or more.
Yeah, for generics. Yeah.
And a 60% margin or better. So those are the kind of 4 keys on those generics. And, at the end of the day, the percentages are nice, but the dollars matter, right? And so that $20 a script can, what we're seeing a lot of times, if you've got, for instance, if you've got a 60% margin on your generics, and by the way, you're probably driving maybe a 1 or 1.5 on your brands, 1.5% versus 60.
If you're lucky,
65, hopefully on your generics, hopefully 1.5 to 2 on your brands, just depends on your mix and your payer mix. But 60% of a $15 generic is $9, right? $60 of a $25 generic is $15. So that's where the dollars really, you want a 60% margin, but what you really want is to see that you're making north of $20 a script on your generics. And that's not making $20 a script. Sorry, that's revenue. That's the revenue per script. So those are the 4 things we look at: percent of fills between brand and generic, percent of revenue between brand and generic. So we like 90% generic fills, 20% generic revenue, $20 a script revenue generic, and 60% gross margins plus.
And why does this become important? Because it tells us what you've got to go do to improve your business, right? So, for example, if we look at your generic brand mix and we see in your generics that you're selling them for $22 a script, you have a 60% margin, we're like, okay, there's something here. But then we look over at your brands and your brands are making up, let's say 20% of your volume. Well, the brands now are sucking all your profit out. And like what's occurring right now with a lot of things is GLP-1s, right? They're going like this and you're making no money on them and it's sucking all your cash. What's also causing you to miss out on rebates, bringing down the generic. So that tells us, okay, take some time, try to figure out how to move things from brand to generic. If you can't, are there brands that you maybe shouldn't fill and can weed away at those? And now suddenly your margins will come up and you have better business. If we see that you're making $15 a script in sales for generics, like there may be nothing that we can do there. Your brand generic mix may not matter.
Right.
And so then maybe we need to kind of figure out how you're going to start cross-selling things adding services, because there's not enough meat in the generics to to improve your margin. So let's not go through this whole exercise. Let's find other ways. You've got this big patient base. Let's find other ways to make money. So looking at these pieces of data like this tell us where you should focus. Same goes with payroll. You know, we see with payroll, it'll be like, oh, this person looks over payrolled. Well, then we get into the payroll data and we realize that they're in a rural area where they can't find pharmacists under $75 an hour. Well, there's nothing they can do about it.
Yeah.
So then instead of cutting payroll, we're going, okay, how can we do things more efficiently, or how can we sell more like services or what have you, or add-ons with the employees that we have. So knowing where you are with these things allows you to know where to focus, because you only have so much time and you can only do one or two things.
Yeah.
And so, you know, as we dig into this data, it tells us a story, which then gives you the ability to go do something about it, which is ultimately where you're trying to get, is to go. I mean,
Yeah.
What's the purpose of having this data if we're not going to act on it?
Yeah, and sometimes more often what we'll see on the payroll side, and one of the metrics we used to go by was if you're a higher volume store, so you're at least, let's say 1,400 scripts a week, you should be closing in on 10% of payroll or total personnel costs, not just payroll, total personnel cost to revenue, right? So an
example would be if you have revenue of 400,000 a month, your total payroll cost would be 40,000.
But that's getting kind of confusing now, right? Because all of a sudden GLP-1s are on the scene and you're spending $1,000, or they're driving $1,000 of revenue, and you're spending $1,000 to buy them. But that's overinflating your revenue. So now your revenue, so that ratio might look really nice. You're at 10%, but your revenue is really overinflated because your average price per script is no longer 55, 60 bucks a script. It's now 85 bucks a script because you're filling a ton of GLP-1s. So you got to be a little careful about those type of ratios. But you know, what we'll commonly see is stores that are, you know, filling, let's say 1,000 a week, and they've got a bunch of pharmacists overlap in the store. And we're like, well, in today's day and age, that's nice to have, but that's generally not affordable, right? And a single pharmacist in our view, when we had all our stores, you know, a pharmacist could fill even up to maybe 1,400 scripts by themselves. Now that's pushing it.
That's pushing
it. And maybe there's some overlap on a Monday and an overlap on, you know, a couple days
Friday
a week and so forth. But those are the things where you start digging in and say, okay, my payroll looks like I'm over payrolled. Where exactly is that?
Where is that occurring?
Where is that occurring, and how is that occurring? Is it because I got to pay $85 an hour to my pharmacist, or is it because I've got too much pharmacist time?
Or do I have too much overtime?
Am I running a ton of overtime and paying time and a half to my pharmacist if I'm in California, especially where 8 hours a day, right? So it's just meant to give you, again, going through this analysis and getting an understanding of where you should be where you are, and then ultimately where you should be, and picturing it in a monthly basis, I think helps break it down and simplify it, and then helps you zero in on where your challenges are. Is it payroll? Is it purchasing? Is it, you know, my volume? Is it my payer mix? I mean, we haven't talked about Express Scripts and everything going on there right now, but there's just a lot of different areas that, you know, you can go down the rabbit hole, but you got to to do any of that. The starting point has to be that you kind of have to know what my numbers typically are. And do I have a problem? And if I do, you know, where do I go start to dig?
Well, we have a question here about would 340B help with that? Well, that's exactly what we're saying, but you know, I can't tell you how, I mean, what you're trying to do is go, 340B could potentially help if it's a good 340B contract. We've also seen it do the opposite, where it's not a good contract and it's actually hurting your margins or hurting your cash. And so, again, what you're trying to do is understand, what is driving my gross profit, good or bad? And is there something I can do about it? It could be that, yeah, you're working with this nonprofit and they're sending you all this business, and you could be having a 340B contract and you've done nothing about it. Well, then, yeah, let's go fix that. It also could be that you're delivering half of this stuff and it's all being packaged and you're billing it and you're delivering it to a facility and you're not using GeriMed. And so now you can convert 300 of your prescriptions a month or a week into a GeriMed contract and get reimbursed better. It could be that it's a combination of those things. However, the problem that we see is that people just go get things and oh, this is happening, I'm going to try that. Instead of going, where am I? What's causing it? What should I do about it? And focusing in and doing the one or two things that'll make that impact, that's a great impact rather than a little one.
Yeah, I'll tell you, 340B, think about that, because typically 340B contracts right now are paying 20 to 25% of revenue. And we just mentioned, and it's all brands, right? So there are some I think that are generic, but we just talked about your average brand margin is at 1.5%. Can you imagine what a 340B plan can do if you're getting 25% of brand revenue at no cost? And the no cost is the tricky part, because on a 340B plan, the covered entity is buying the drugs and they're giving them to you. So as long as that replenishment is occurring and it's timely
and accurate,
then making 25% on your brands versus 1.5
is
home
amazing.
run.
They screwed up that replenishment.
The replenishment's what gets you, and the cash flow can kill you, even though that's where an accrual P&L might look really nice, but the cash flow will kill you, right? So you got to be careful with 340B plans and get somebody involved that really understands it to make sure it's being handled properly. But 340B can be a game changer. Like Owen said, long-term care, how many times have we gone in and we find out that they're packaging and sending to a facility and they're just billing regular retail codes? So got to fix that. There are things in there that, as you pull this back, that you can start to understand and change.
Some people have, and we just did a webinar on this, some people have debt that's gotten higher because interest rates have gone up, right? So they bought the store and their interest rate was at 5% and now it's 11. And so their debt has gone up, but they could maybe go back and refinance that and re-amortize it. So now their debt payment gets cut in half. And so now that's cash that's not going out. So again, understanding, where's your hole, and just doing that simple, what can I expect in revenue on average every month? What is my gross profit on average every month? What is my payroll typically every month? And then that's another thing we see all the time is you'll get 3 payrolls in a month. People were like, where's all my cash? And it's like, well, then if you know what it's supposed to be, you'll probably know, oh, well, that was a 3-month payroll. All right. That was just a one-time thing. Next month it'll be better. And then also, what is my other operating? And then what's my debt? Well, can I figure out a way to have less debt payments? So, you're just trying to, and if you have that baseline, well, then that tells you where to go look. And see if it's fixable. If it is fixable, you can fix it, and then you can move on to the next line and go, okay, what can I fix about this line? And you work through that. And believe it or not, it's so funny. We see people, they'll make a little GeriMed change here. Then they'll change their buying here. Then they'll slim $2,000 worth of payroll. Then they'll refinance their debt, and suddenly they go from like cash flow even to making 10 grand of cash every month. And they're like, well, we don't even know how it happened. And it's like, well, you did these little tiny things and you found the holes and you've corrected them. And to going back to what you said, you've got to do it all right. You've got to have good revenue. You've got to buy properly. You've got to run with the right payroll. You got to keep your other operating expenses are. You got to figure out how to lower your debt. Each one of these things adds up.
You just have to make sure and we see too much of this where people are still flying pretty blind, right? And by the time you realize that things aren't going well, it can get late quick, right? And all of a sudden you're almost out of cash, and then it's really hard to have the time to fix things. So getting your head around, am I cash flow positive? Hopefully you are at this point. And if not, making those corrections, and hopefully at least operationally that you're.
And when you make those corrections, so let's say it's the generic versus brand mix, and you fix it and you're like, okay, generics are now 90% of my fills. Well, you should track that every month and make sure it's staying at 90 and that you don't start slipping down to 85. So that's a number you start averaging and going, okay, and so now you start tracking these certain little pieces that make your business good. And you've got a little sheet that tells you, okay, is something changing? Right. And, again, we try to look at that stuff on, even our generic mix and our brand mix, we look at it it would be what, 16-week trailing, right? And so it every week actually it refreshes and it tells us, is their generic mix starting to change, and then we can catch that and do something about it potentially.
But what's been interesting is, the difficult times has prompted people to make changes, right? And so I would guess that 90% of our stores, either through our conversations with them or just on their own, and probably you guys as well, have altered the GLP-1 fills, right? So it either doesn't make sense at all, and you're not filling them at all, or you're in a state where you can pick and choose where you're going to fill them for certain plans, or that aren't profitable, not fill them. But you think about the economics, even if you're break even on those and you're not losing money on it, if you're filling 20 GLP-1s a week, that's $20,000 of purchasing a week, and you're dispensing it. The good thing is none of it's going on your shelf. Hopefully you shouldn't have any additional ones sitting on your shelf unless you got enough walk-in traffic that you're doing that. But so it fully gets dispensed, and then you're going to wait 2, 3, 4 weeks to get paid. So you're going to buy $20,000 worth of drugs, you're going to dispense it, and then you're going to wait 3 to 4 weeks to get paid. Now, if your payment terms are such that they match up
or something,
then you probably don't have that much of a cash flow issue, because you're getting them in your store, you're administering them, you don't have to pay for 2 or 3 weeks, and you're going to get paid in 2 or 3 weeks. Those two match up, and it's a wash from a cash flow standpoint. But you may be losing money on those. But that's the analysis you got to do. We've got another store that we just looked at that eliminating a lot of their brands altogether, and so all of a sudden
their margins are 40%.
Their margins are 40% because they're driving that 65, 70%, 65% on their generics, and they're driving the 1% on the brands, and they're getting rid of the brands, and all of a sudden their margins go from 18% overall to 40%.
Yeah, and they've added some long-term care, and
their revenue comes way down, right?
Yep.
The revenue is way down, but their margins are up and their profitability is up. We've got another store that doesn't do any brands anymore. They send all the brands away, and we thought, well, that could really tank the business, right? We were
worried about customers.
We were worried about people saying, well, if you're not going to do everything, I'm going to just transfer my profile. And they have maintained a very strong presence with just doing their generics. And so
we've had other people where we've gone through this analysis and they have a bad mix and there's nothing that they can do about it. Well, they started charging for delivery. It's like, well, I'm doing 1,000 deliveries. Well, I'm going to charge for those. Well, guess what? And they were like, oh, well, we're going to lose customers. They didn't lose any customers. And now they're making an extra $5 per delivery. Like it's helping. that helps their margin because it's revenue.
Right.
It's not RX revenue, but it's revenue. So that, fixing the margin was not possible.
Yeah.
They were doing everything else right. So we had to come up with another creative way to do it. And that's what you're doing here. Yeah.
I guess the whole point of this webinar though was, as opposed to figure out a lot of different ways of doing things, was to make sure that you're doing the most essential piece,
Yeah.
which is understanding where you are from a business today. And looking at it on a regular basis and understanding. And again, I think that monthly view is the most important piece, because you can wrap your head around, I'm making $5,000 a month. So multiply that by 12, I'm making 60 grand a year. I can do better. I need that to be 10. So I'm making 120. On top of paying myself a pharmacist salary, I want to make 120. So I need to get that to 10. Or, hey, I'm losing $5,000 a month and that's depleting my cash. And at some point I'm going to run out. So I got to fix something. Something has to change here. So I've either got to grow the business, I've got to purchase better, I got to manage my payroll. I got to do all three of those things. So I think the main emphasis today was just, when we sit down and I'm going to have a call with a client, I'm going to pull up all their data. I'm going to go through this. I'm going to say, where are they? How's that changed over the last, few months? Are they trending correctly? Where are the problem points? Where are the good points? And, that monthly view of the world, from a gross margin, and knowing that, hey, I got 40 to spend, I got 80 to spend, I got 100 to spend. And if I'm spending 120 and I've got 100 to spend, I got to start fixing some things. And I think we just see too many that are in that category where they are bleeding cash, or they're leaving cash on the table.
Yeah.
And they're not addressing it because they're just unaware. I mean, they don't feel like things are going. And again, when you look at it month to month to month, it's doing this. It's hard to get your head around that. And that's why we talk about using those averages over the last 3 or 4 months to kind of get a feel. And the more you look at it and the more you do that every month on a regular basis, the more you'll get in your head, this is where I should be, and figure out where you are. Then the next month rolls in and you can say, how is it compared to where I think I should be and why? And use both. If you've got cash basis financial statements, you can look at your cash margins, and then you can go over to your pharmacy system and see if it's telling you the same story. And if there's a difference, there may be reasons. If you're really growing, your cash margins are going to be lower than your accrual margins. But if your business is fairly steady, they should mirror each other at some level.
Yeah. And I think, we've got a couple questions about industry averages on here. I think what Rich is trying to tell you is you need to look at your store. There is some industry averages, but I'll tell you, I mean, it just is it swings so wildly from store to store that, you might want to look at some of that, but I think you need to know what your store is doing. So my point here is if you do $700,000 in revenue to get your 80,000 in margin, and you have payroll of 40, and you have other expenses of 20, and you have 20 left over, you've done something right. Your margins are going to be different, and your payroll as a percentage of sales is going to be different than someone who did the same thing with 400,000. So you need to understand what is driving that.
Mm-hmm.
What causes that? Why? Is it 340B? Is it compounding? Is it that your Medicaid pays very well? You need to understand it. So is there some industry averages? We kind of look at them. We do a little bit of benchmarking, but I'm more concerned with what is this store and why?
Yeah.
And what can be done to either maintain it or improve it. And so that's literally why we do an analysis per store. We start from the beginning and we go through exactly what we just said and try to understand the monthly averages and what's driving it.
Yeah.
And so I would encourage you to understand your store and what drives it, and not necessarily compared it to industry averages.
Yeah, because it's just stores are so unique.
More so than ever.
So many different ways in terms of maybe they're doing a lot of brands, or maybe they're doing a 340B plan, or they've got long-term care. So margins can be anywhere from 10 or 12% to 35 or 40%, right? And I would say on average, the average gross margin that I see right now is probably around 17.5%. And I hate to say that. I don't.
It is.
And that it wasn't too long ago that number was, 22%. Part of that though is just because of more brands. And so the revenues are higher and the margins are the same, and the margin dollars are the same. And so the margin percentages are dropping. So it's not always an indicator, to Owen's point, of you might be filling the exact same volume, but the mix is different. And so the percentages can be deceiving. It's the dollars that count, and you do need to look at your store, on a case by case basis. And one of the more challenging and interesting things we do is we also do valuation work, right?
Yeah,
so
a lot of it.
And that's kind of my background. I was in mergers and acquisitions in a large company, and bringing this to the small business is really interesting, because they'll send us tax returns, they'll send us pharmacy data, and I'm not going to do evaluation if I don't have pharmacy data. I can't tell you what your pharmacy is worth if you just give me financial statements and a tax return. I need to see the underlying
why.
Yeah, why, to prove it, because you get some crazy numbers, and then for us, it's putting a puzzle together, right? We see this isn't a store that we've worked with for years and we understand their data. This is, who knows if the stuff's accurate. And so you get a lot of questions that come up, and try to figure it out as to why they're doing the margins that they're doing. Are they really driving the revenue and ultimately the cash, because it's going to be valued based on the cash flow. And so taking a store and just being handed some documents and sorting through that and saying, what's it worth, is a real challenge, but it shows you also the uniqueness of each store and the variation in the quality of the data that they can provide you to help you go back and tell them, what their store is actually ultimately worth, which is a big deal.
Yeah, so hopefully this was helpful for you. It is being recorded, and we will put it on LinkedIn, Facebook, YouTube. It'll be emailed. It'll be on our website. You can watch any video that we've ever done on our website or on our YouTube page. We had one other question. What do we charge for store analysis? Typically for evaluation, it's $2,500 unless there's something really complicated, or it's 8 stores or something like that. So we can do evaluation, store analysis. So
if you're more interested in our we'll do a call and a demo of any of our services, right?
Oh, yeah, that's free.
On the ongoing side, and kind of have a conversation with you about it, just about anything as we.
Yeah, that will do for free if you just want to call up, but to do a full valuation store analysis.
Yeah. With a formal document coming out. Otherwise, I have conversations every week with stores that prospective clients and people that just kind of call in and ask questions. So be happy.
Feel free to reach out. Yeah. Hopefully that was helpful. You can find us on our website, independentrxconsulting.com. We're both on LinkedIn if you want to send us a message there. Thanks for joining us, and we'll see you here.
I don't know if we'll have a booth. We'll be at the McKesson Trade Show.
Yeah, we'll be at the McKesson Trade Show as well, coming up if you happen to be going that. And NCPA is in Columbus this year, so that's about an hour from us, so we'll be all over there too.
We'll have a booth at the ownership workshop. We just had a booth at Pioneer, so we are out and about. If you're at one of the trade shows, maybe you can hunt us down and talk to us in person.
Yeah, thanks for the time.